This is Pete Moore on Halo Talks NYC. I have a friend of mine coming in from North Carolina, Aaron, Live Oak Bank. We are going to talk about debt financing and the reemergence of the health club sector. Aaron, good to have you on the show.
Likewise, good to be on.
Awesome. So, as a debt provider, given that's been your career, your first goal is always preservation of capital, making some money on the interest, helping companies grow, and probably a lot of success stories along the way. So why don't you give your background on Live Oak, and then let's talk about the new normal.
Yeah, sure thing. So I've been with, Live Oak was founded back in 2008, solely going to be a niche-focused veterinary-only bank. And then from there, we've kind of slowly grown. And you flash forward today, we're in 30 different industries across the board nationwide. Started in the bank in 2014 as an underwriter, then kind of transitioned into sales in our medical real estate division. And, we've, as a whole, whenever we look into a new sector, it's always targeting recession-resistant industries and really kind of becoming niche lenders even within an industry. And so in 2017, we started researching the fitness space. Then 2018, myself and my colleague, Angelo Medici, kind of got involved and launched this vertical from the ground up. We like to think ourselves as niche lenders within a niche space. So even, look at fitness across the board, high default rate, high risk, very, fad and trend driven. And so focusing more on your tried and true, your well-rounded concepts, your established multi-unit borrowers that have access to capital, and providing them with a debt platform to really enable them to kind of take that next step as they grow.
Got it. So when you take a look at investing behind a private equity fund or some kind of institutional capital versus investing directly with an entrepreneur, how do you guys think about that?
Yeah, so we look at all types of sorts of deals. We're dealing with the onesie twosie small unit operator, as well as the 20 plus unit access to institutional capital. But first and foremost, we want to hear your story. We want to hear why you got involved. An intro call, very rarely are we actually discussing, financial numbers. We can get that information down the road, but we really want to vet you and understand your story and how we mesh with that from a relationship standpoint.
Got it. So when you take a look at private equity fund comes in, buys a platform, let's say pre-COVID, they, came to an agreement on a 7 or 8 times EBITDA deal. Where's kind of your comfort zone from a leverage ratio, and, how has that changed, given the current situation where there probably isn't any real EBITDA?
Yeah, it's a great question. So historically, we like to think of ourselves as a senior debt holder. We don't like to go beyond kind of that 4x leverage. Is kind of where our comfort zone in this industry is. And beyond that, we kind of think of that as high leverage and really like to stay kind of in the more 3 to 4 times. And that's an interesting nuance now when we kind of look at this gap where, you might have been shut down for 3, 6, 9 months, don't really have that existing cash flow, existing EBITDA to lend on. And so what we've really been structuring deals, especially, you had an existing operator, great book of business, looking to go and acquire another one. It's kind of a balancing act in our eyes of how do we provide the seller with the comfort of getting some cash out on the table, but not over leverage the business day one to the point where it can't support the debt moving forward. And so we've had a lot of success structuring kind of tranche financing with an earnout based on a 3-month trailing EBITDA number to kind of keep those ratios in line and truly making a product that is comfortable with the buyer, comfortable with the seller, and then ultimately protects the bank's interest as well.
Got it. So, there's been a proliferation of specialty finance companies that, traditionally you go to a bank, you borrow money, they want interest payments, they want principal back over time on an amortization schedule. There's a lot of groups now, whether it's insurance companies or pension funds or endowment funds that are basically just looking for a return and a fixed return, and basically don't want the money back from the borrower. So can you kind of give us a little insight into how you think about that? Is that a good thing? Is that kind of chasing returns and creating like this capital stack that's forever on a company?
Yeah, it's certainly a balancing act there. We as a bank are much more, true fully amortizing term loans, probably looking at a 5 to 7 year amortization schedule. That's not to say that, there's not value in getting an AM free, especially in this kind of interim gap where it really enables you to ramp up to what your pre-existing EBITDA was. And so we've actually had, we're a little bit more constricted being a FDIC bank, regulated bank, as opposed to some non-bank lenders out there that can, do exactly what you alluded to. And so we've had some success as well with partnering, kind of bridging that gap.
Mm-hmm. And, without naming names, how have you guys treated, the uncontrollable nature of COVID shutdowns, members on freeze? I'm assuming you believe on the other side we get back to some semblance of normalcy, but you've got a bank and you've got your constituents and you've got your constraints. So how do you kind of balance that?
Yeah, it's interesting, Pete. And, no day is the same. One day I find myself playing the role of morale coach and talking someone off the ledge. And the next I'm competing in a highly competitive leverage buyout. And so, so much of this is a lot of geographically driven. We've seen our portfolio across the board, in states that have been able to open and remain open have proven extremely well. And if you use membership base as a forward-looking metric, some of our largest exposures are operating right now at an 85 to 90% membership on a year-over-year basis, which we view extremely uplifting and further testament to our investment thesis in this industry. Now, states California, New York, New Jersey, much different story there.
Yeah. So, as a bank, you typically want to look at, as you mentioned, recession resilient or recession resistant businesses. Debt investors typically get involved in deals that have relatively low technology risk. How do you feel about the health club industry now with the flood of venture capital dollars urging people to work out from their home, probably not getting any results over time, probably not making too many new friends, although they preach community through a LED screen, which I'm highly critical of. So how do you kind of think of the health club industry? Do you look at it and say, technology risk, like you deal with it every day when you get a new app that somebody wants you to download, and that's just kind of the new world? Or do you view leverage ratios maybe having to compress because there is a lot of technology risk?
Yeah, I think, look, there's a lot, and certainly a lot of unknown there, but I think you and I sit on the same side of this, that there's no doubt the industry is going to be changed forever. The innovations are at all-time high, and that's not necessarily a bad thing for, your tried and true membership model. But I think at the end of the day, there's nothing new. There's always going to be a Bowflex or some new concept that was good. What, did that change the industry forever? No, the membership model is tried and true. And I think getting, coming out of this, we as humans inherently want that human to human interaction and are willing to pay a premium for it. It's the same reason that, you're willing to pay $10 for a beer at a bar versus sitting on your couch at home. And I think never more than now, especially with, corporate buildings possibly not returning to a work from the office setting. So you're going to miss that human interaction and you're going to search for it elsewhere. And I think health clubs stand to benefit from that.
Yeah. When you take a look at some of the boutique fitness studios, what's your current thesis on that? Obviously, with the capacity constraints, it's been hard for any of them to actually get above break even. But do you view that longer term as something you guys would finance, or you kind of like the bigger boxes?
Yeah, as a whole, we've shied away from the smaller boutiques. Kind of saw the writing on the wall that there was, too much concentration out there, too many offerings, and if there is an inevitable downturn, are you going to want your yoga membership, your cardio membership, your strength membership, and eventually you're going to need to consolidate if you're forced to. And so we've benefited from that from a portfolio standpoint. And there's no question that the capacity restraints limit group training far more than they do a big box. That's really just reliant on your monthly draw and doesn't, really care if you show up to the gym or not, as long as they're able to continue to draft your account. Now, with that said, the boutiques do have a stronger loyalty, much more drive to get back to that facility right now. You might know the personal owner or have a relationship with the trainer there, and that's kind of your driving force. But I think for the long term, they're in for a world of hurt, especially for the smaller kind of mom and pop shops.
Got it. So a couple of things were going on pre-COVID, where a Planet Fitness franchisee would say, look, here's my EBITDA of this location, but I also want you to look at, the prices that these locations are selling for. So just to give you an example, somebody pre-COVID said to us, well, I've got 5 Planet Fitnesses and I know I could sell them for $40 million. Mm-hmm. So I think on a loan to value, I should at least get 50% loan to value. I kind of started to throw some other metrics, out the window. And I think anytime there's an exuberant market, people start to enter into a gray area, and, a club that's got a shovel in the ground somehow is now, valued at what it's going to be worth in 3 years. So how have you guys stayed disciplined? Where have you gotten comfort on stretching or maybe kind of recalibrating how you think about debt and asset value?
Yeah. And this is where it becomes so much more of a transactional by transactional basis, because we are first and foremost cash flow lenders. And so how do you, as a cash flow lender, get comfortable when there is no cash flow to lend off of? And so then it really comes down to, what is your relationship with that owner and operator? What is your relationship with maybe their equity sponsor? And really understanding their run rate from a equity and balance sheet standpoint. And then you kind of mold those two and get comfortable that, look, there is a light at the end of the tunnel. They do have the equity backing behind them to continue to support a ramp up of this nature. And then how do we sprinkle on some senior debt that enables them to do so?
Gotcha. So when going back to the point about you guys putting money into a private equity backed deal versus going in, and if, Dave Ganelin and I decided to open up and we got 10 locations, but we don't have quote unquote institutional capital behind that, why we got to sign a personal guarantee and why the private equity guys don't?
Yeah. So, just to use rough metrics off our heads, we typically require PGs when your true EBITDA is $2.5 million or less. But, moving beyond that, if it's just like our thesis is the PG, regardless, if this is your dream, you believe in it, why would you, it's almost more of a red flag if you're not willing to PG it. And we certainly understand that once you continue to grow and grow that, you're inevitably wanting to get that off the table. And then it comes down to, truly finding comfort with that sponsor and vetting them. Is it the first time that they've entered the wellness space? When things do go belly up, do they continue to, cash the check? Because to be frank, the equity group is only as good as the next check they're going to write. And so, we've really have been very fortunate in seeing that, the equity backed deals that we had kind of going into COVID, wow, those sponsors really did what they said they were going to do, enhance the balance sheet coming out of this, because, our inevitably it's going to be a situation where only the strong survive, and in some ways stand to benefit from the environment around them, just given that, not all of the competition will. And so there will be an influx of, pent up demand, membership available for those that did have institutional backing or access to liquidity on their own end to kind of get them through this dark year.
Got it. Good answer. We're still going to question whether Dave and I want to sign the PG. We believe in this, I swear.
Yeah.
I don't know if COVID 2020, if COVID 22 hits, I got a big personal guarantee on the line with you guys.
No, understood. We always use the eye of the tiger analogy here. So, that's when it comes down to us meeting you face to face and understanding the owner operator, the management team, who all's involved, and are they fighters? Because those are the people you want to do business with.
Yeah, understood. When you take a look at companies that have taken PPP money and now there's an employee retention credit, or other government programs, I don't know the answer to this, and I figured, why not ask an expert? So how does the PPP money rank if you guys have a debt facility does the PPP loan, let's say it's not forgiven and the company used it for other purposes besides payroll, does that somehow sit ahead of you, sit behind you? Do you have veto rights on them taking a PPP?
Yeah, so it's an interesting question. And we, as a bank, we absolutely have a conventional and larger specialty group. But, first and foremost, we're the largest SBA lender in the country. And so we have to put an abundance of reputational risk at stake when it does come to an SBA federally backed program like the PPP. And so, we were heavily involved and continuing to be in ensuring that all of our customers have access to that capital. Because the way it was designed and very lenient on these industries within the Halo world that, we're heavily impacted. And so, if anything, it's ensuring that, look, did you continue to do what you said you were going to do? Did you use these funds wisely? And then, we have full comfort.
Gotcha. That makes sense. So do you view, somebody comes back to you right now and says, hey, I got an opportunity. I know my metrics aren't kind of in your strike zone of your 2.5 or 3 times, but Aaron, I can pick up these 10 clubs right now, or I go into these vacant boxes. For some reason, I don't want to put equity in. So my first call is to call you. How do you how does that conversation go? From a risk sharing and an opportunity sharing, and maybe for people to understand, if this company does what it says it's going to do, you're not really benefiting from the spoils of that because you're not in the equity. Maybe explain that for our layman's terms here.
Yeah, it's a question we get a lot. Look, my cash reserves have been hindered. I got to preserve that liquidity to protect my existing assets. And I always frame it with, that's great. We're all for preserving liquidity. We don't want you to be in a situation where you're putting all of your eggs in one basket. But why should we as the debt holder take all the risk coming out of this? Especially when, yes, there's a vaccine on the way, the light appears at the end of the tunnel, but we don't know how much that tunnel is still to go or what could come around the horizon. And so it's very much a balancing act and something that we have a ton more flexibility if you're coming to us as an existing debt holder within our portfolio that we can restructure, work with you on that, pre-existing senior piece. If you're coming to us from an outsider, inevitably there's going to be greater limitations there. And how do we get comfortable restructuring that someone, they might have been perfectly, in a very comfortable 3 times leverage coming into this. Well, if their EBITDA tanked, that leverage remained the same, we're not in a position to refinance that debt. And we do have to take that into it with a grain of salt if we're looking at, carving out an outside, ramp up traunch facility or what have you. And so it really comes down to there is, what type of flexibility, if you weren't an existing customer, were you able to get with your existing piece? And then how do we negotiate and structure a deal that doesn't require you to pour all of your eggs into this basket, but doesn't put us in a position where we're over leveraging you day one. And so that's where, we've really kind of honed in and, walked through these kind of earnouts and tranche draws moving forward for the time being while there is so much uncertainty.
Got it. And then one question I have, you touted earlier in a positive way. Touted, I'll use that as a positive.
Yeah.
You've touted that you're a big investor across the entire sector. If I've got clubs in New York City and I'm under a brand and I've got a debt facility from you, and then you lend money to my competitor as well, do you view that from your standpoint as like, yeah, I've kind of diversified my risk, and at the same time, I could probably infuse maybe some knowledge that I have across the country of what other people are doing. But at the same time, I'm posting up against a competitor and we're all basically running money for you in a sense, or borrowing money and using it. So how do you think about that? Because I think the world has gotten very complicated where there's money sources all coming in from the same pockets.
Yep.
So how do you think about that?
Yeah, I think I can certainly understand why someone might go that route in diversifying their own risk. But I think that goes against everything we as a bank stand for. We are a relationship bank first and foremost. And wanting to not only, do this initial transaction with you, but how do we continue to help you grow every step along the way? And I think if we were to be, short-minded like that and not protect those that stood by us from the get-go, we'd be doing ourselves, our reputation, and the whole industry a tremendous disservice. So that's something that we are very against. I'm sure others do it. And look, I get it from a credit standpoint why you might want to diversify that. But I just think that goes against everything I'm about.
Got it. So in closing here, what's kind of the minimum number of clubs, minimum pre-COVID EBITDA in order to put a call into your email and see if you're interested in financing deals?
Yeah, I would say from a financing dollar standpoint, anything from the 500,000 to 15, 20 million, and getting beyond that, we do have access to capital markets and syndicates that can look at larger transactions. But I think it more so comes down to a leverage standpoint. And looking at the cash flow, because that's what first and foremost we are, cash flow lenders. So wanting to stay within that 3 to 4 times leverage, and then looking to structure a deal that's amicable for all parties.
Got it. Great. You got any quotes that you got any favorite quotes down there?
Yeah, not much of a Ray Ra or inspirational quote guy, but one that gets passed on a lot, more of a live oakism, and I think it's applicable now more than ever in this industry is panic slowly. I think we look back February, March of 2020, the world was coming to an end. A lot of us were having an oh shit moment. Is our entire portfolio, all of our work, going to go to nothing? And the fact of the matter is the industry has been incredibly resilient. And so, taking a deep breath, understanding the data, looking at the forward-looking metrics, and sticking to your initial thesis and not wavering through that, no matter how dark things go.
Awesome. All right. Well, I'm glad we were able to connect on that webinar. Let's see if we can help continue to grow the industry. And we look forward to you financing some of our next best ideas that are coming down the pike.
Likewise, Pete. Really appreciate it.
Awesome. All right. Good stuff.
As we continue to build our Halo Talks email notification database, want to offer you a free $10 instant gift card from our friends at Promotion Vault. Also to show you how easy it is to offer your members and prospects and clients the ability to get desired actions out of them and reward them in real time. Go to halotalks.com, put your email address into the pop-up box, see how it works, get a free $10 gift card from us, and keep listening and making everybody great.